Yeah, okay, thank you very much. Good morning, everybody. Welcome to this meeting of the Dorset Council Pension Fund. Firstly, just want to say a welcome to Councillor Simon Christopher. Are you with us somewhere?
Chairman, I've just rung him and got pushed through to his answer phone, but
Okay.
he has spoken to me, so I am expecting him to arrive.
Okay, well, we'll probably deal with that in a minute. I also wanted to say formally a big thank you to Councillor Ray Bryan, who's been on this committee for the last 4 or 5 years, I think, something like that, and has been a very good, positive contributor to the work of the committee. And we wish him all the best of luck with the rest of his portfolio on Dorset Council. Those who know him know he does a huge amount of work.
On board.
Sorry, Peter?
Councillor Christopher has just come on board.
Okay, great.
Good morning, everyone.
Good morning. I was just introducing, everybody to everybody. I think we should just go through and do a slight roll call, just to check who's here and who isn't. Firstly, looking at from the point of view of the Dorset members, obviously myself, I'm Councillor Andy Canning. I'm the chair of the committee. Peter?
Councillor Peter Wharf, vice chair of the committee.
Simon Christopher?
Simon Christopher, Dorset Councillor, Marshwood Vale.
Howard Legg?
Howard Legg, Dorset Councillor, Upway Broadway.
Mark Roberts?
Good morning, everybody. Councillor for Chesil Bank Ward along the coast.
Okay, and all those people represent Dorset Council, and those representing Bournemouth, Christchurch and Poole, Councillor John Beasley.
Good morning, everybody. Councillor John Beasley, representing Bournemouth, Christchurch and Poole Council.
Councillor David Brown.
Yep, Councillor David Brown, BCB Council, Ward Member for Bearwood and Merley.
And Councillor Robbie Dove. No? Are you there? No. Okay. And representing the members of the pension fund, Adrian Felgate.
Morning, Adrian Felgate, scheme member representative.
Thank you. And the officers that are here today, Aidan Dunn.
Good morning, I'm Aidan Dunn. I'm the Section 151 officer for Dorset Council.
Jim McManus.
Morning, Chair, morning members. Jim McManus, Corporate Director for Finance and Commercial for Dorset Council.
And David Wilkes.
Morning all, David Wilkes, Service Manager for Treasury and Investments.
Okay, our independent advisor is Alan Saunders.
Alan Saunders, representing MJ Hudson, and also a council taxpayer from Corfe Castle, Purbeck.
And representing Brunel, David Vickers.
Yes, good morning, David Vickers. I'm the Chief Investment Officer at Brunel.
And Catherine Dix as well.
Good morning. Yes, Catherine Dix. So I'm the client representative for client relations manager for Dorset. So work closely with Dave and the team.
Is there anybody else I've missed out? Speak now, forever hold your silence. Okay. I'd like to point out that at the annual council meeting of Dorset Council on 4th of May, it was agreed that all council meetings that were not executive in nature would continue to be held virtually from the 7th of May until such time as social distancing requirements were removed, which is currently scheduled to be the 19th of July, I'm afraid. Where a decision was required, committee members would express a minded to decision in respect of recommendations set out in officer reports, with decisions being taken under officer delegated authority in the light of minded to decisions expressed by members in the virtual meetings. Accordingly, this meeting has those arrangements in place. Okay. Moving on then to the first part of the agenda. Any apologies?
No apologies have been received, Chairman.
Chairman, if I may, this is
Yes.
John Beasley. I spoke to Bobby Dove yesterday. She had hoped to join us, but I know that she has something personal that she needs to deal with. I thought it was at the end of the meeting, so she may join us part way through.
Okay, we'll watch out for her then accordingly. Moving then on to the minutes of the last meeting on the 11th of March. Are people happy that they're a true and correct record of the meeting?
Mm-hmm.
Thank you very much. I will sign them in due course. Moving then on to public participation. David, do you want to introduce this?
I think we've had a number of questions from members of the public, and I believe you were going to read out a statement, Chairman.
Yes. Basically, we've consulted with Democratic Services about how to deal with the issue of questions that have come in. Bear in mind, we've had a fairly large number of questions which are all broadly similar in their approach and what they're being asked to do. And in line with the consultation I've had with member services, I'm going to read out this statement now. We have received a large number of questions from members of the public regarding the pension fund's approach to investments in fossil fuels, and we welcome the interest in this important topic. Written responses to each of the questions will be published alongside the minutes of this meeting, but I would like to make this statement today. This topic was discussed at length at our meeting in September 2020. The reports, minutes, and a recording of those discussions are all available on the Council's website. I would like to remind everyone that the purposes of the pension fund is to pay benefits to scheme members, and the committee has a duty to scheme members and their employers to ensure that their contributions to the fund are invested appropriately to make returns sufficient to meet those obligations. This duty overrides any other considerations. The approach agreed by the committee in September 2020 was not to divest completely from companies involved in the sourcing and refining of fossil fuels. Instead, we will seek to reduce investment in all high carbon emitting companies and to influence the demand for fossil fuels and their financing, not just their supply. The decision was based upon evidence presented by the committee by independent investment consultants Mercer that a strategy of decarbonisation can deliver significantly greater reductions in the carbon footprint of investments than can be achieved through divestment. Divestment is effectively a transfer of ownership that does not directly lead to a reduction in either the supply or demand for fossil fuels, but it does remove the opportunity to influence companies by working with them to transition to a lower carbon future. I would like to add, however, that targeted divestment remains an option for individual companies who will not positively engage. Significant decarbonisation has been and will continue to be achieved through the transition of assets to the management of the Brunel Pension Partnership, Pension Fund's LGPS investment pooling manager. 10% of the pension fund's assets are now invested in Brunel's Global Sustainable Equities Fund, which is 20% of our total equities and is the fund's largest single investment. All other actively managed Brunel funds are committed to a policy of a 7% year-on-year reduction in their carbon footprint. Brunel's quarterly reports considered by this committee and publicly available include summaries of the carbon intensity and extractive exposure of all the funds we are invested in compared to industry benchmarks. Brunel are widely recognised as a market leader within this field, and their website includes details of the underlying investments of all its funds, plus a wealth of information relating to its engagement activities with companies, including voting records. In 2022, Brunel will complete a stock take of their approach to engagement and divestment. If this review concludes that companies are not taking appropriate action and sufficient steps to manage climate risks and to enable alignment with the Paris Climate Agreement, then the committee will need to reconsider its approach too. And that concludes the statement. Right, moving then on to questions from members. Do we have any questions from members?
We've not received any questions from members, Chairman.
Okay. Any urgent items?
Chairman, would you mind if I just made a point about the statement that you have just made?
Yes, of course. Yes.
Members should be aware that we've had, as the chairman said, multiple questions, all very, very similar. And had we answered them all individually, it would have taken probably hours. The chairman discussed this with me. The chairman agreed this with me, and the response that he gave was also agreed with me. And the response will be available in the minutes. Thank you.
Okay, thank you. Councillor Beasley.
Thank you, Chairman. I just wondered whether the statement you've just read out could be circulated to members of the committee by email, shortly, because it would be very useful for us to use in rebutting many of the similar concerns that are raised with us as members.
Yes, of course. David, would you mind organising that? David's got the full copy of the latest edition. It was also released as a comment to the media this morning as well, saying the same things basically. So we are being consistent in all our approaches to meet these questions. Okay. Is there anything else on that item? No. In which case, we'll go on then to item 7, the investment pooling update with David Vickers from Brunel. Over to you, David.
Thank you, Councillor and Chairman. Can I just ask how long do I have?
Approximately 40 minutes or so.
Perfect. Catherine, if you ring the bell when I'm done, otherwise we'll have a tendency to talk. Well, good morning. I wasn't asked to produce a formal report, so I'll take it as read to a certain extent that you have copies or have at least read the quarter one report that came out, but I will be referencing it as we go through. But as always, as was the case last time, please ask questions all the way through, save them to the end. It's your meeting, whatever you'd like to get out of it, please do question me. I thought I would start by setting the context or having a macroeconomic outlook. I'm aware that Alan will be doing one later on. The only reason I would do a very brief one now is insofar as it sets the context and influences the results of the portfolios today and going forward. So I'm very sure Alan will be able to fill in the details, as it were, but I'll just touch upon the big themes that have impacted your portfolios, your Brunel portfolios, but actually probably all of your portfolios, quite honestly. So I think that's very important. There were times when macroeconomics was not an irrelevancy, but much more of a side issue. But the world we live in and have lived in for quite a while has meant that these macro themes have driven both your portfolio outcomes in absolute terms, but also in relative terms. But as I said, I'm trying to provide the so what to the macro, and I'll do that as we run through the individual portfolios. So very briefly, really quarter one was somewhat a continuation of the back end of last year. You know, after we had the vaccine announcement and markets rather stepped on their tail, so to speak, and rallied very aggressively as the market got comfortable that actually vaccines did work, and that has continued. Despite what variants have been thrown up, the vaccines at last count are still doing the job we need them to do. Thus, markets are looking forward to a world where we aren't in lockdown. 4-week delays aside, hopefully only 4 weeks. Yeah, the market is quite a forward-looking machine. It always looks forward 12 to 18 months in the future. So the big themes that continued over the last 3 months have been a continuation of the economic recovery as people's behavior has begun to normalize, as people have begun, consumers again have begun to look through and enter the vaccine, and that pent-up demand has started to seep back into the economies around the world. You've had a very aggressive, what I would call a V-shaped recovery. So one of the fastest recessions on record, down, because obviously everything shut on the Monday when we were asked to go to stay at home on the Friday, and we've had a very significant rebound driven by government intervention, fiscal stimulus, monetary stimulus, and the furlough programs of various natures around the world. That has meant a couple of other things. That has meant that there have been inflationary fears, because there is arguably, or there was a 300 billion economic hole. This is what Larry Summers, the fairly famous economist and former Treasury Secretary of the US states, $300 billion was missing because of the global pandemic. Something like 9 trillion has been put back into the economy. And, you know, simple economics 101 would say that we have perhaps overgoosed the economy to trap or get us out of what is a big hole, but the size of the response has been of a magnitude much greater than we have ever seen before. Hence, there are fears that there are inflationary pressures running through the economy. They're assisted by the fact that the US central bank, so rather the central bank that sets policies, obviously for the US, but the influence is much greater, have taken a softer line to inflation. They now believe their mandate is to create or not focus quite as entirely on inflation. They believe that where we had a deflationary trend for such a long time, they can allow inflation to go above their target for some time. The fear being have with inflation is that once you let that genie out of the bottle, it is rather difficult to get back in. And we have seen that in the numbers. Inflation has absolutely picked up. We've had some whopper, I think that's the technical term, some whopper inflation prints coming through. Some of that is to be expected. From such a low base last year to recovery, you always get that step change. You also continue to get bottlenecks in certain industries, and semiconductors coming from Taiwan are one of them. It's why actually electric cars and cars more broadly have had a big surge up in your inflationary print. But the Federal Reserve and others still believe today that most of these pressures are going to be transitory. And that's an important thing to note. The jury is out on whether they will or whether they won't, but the Fed are today treating them as though these pressures are transitory, despite, quite frankly, commodity prices across the board hitting all-time highs. So the price of your breakfast, depending on how healthy you are, orange juice at all-time highs, pork at all-time highs, eggs near all-time highs, wheat knocking on all-time highs. We have climbed back up very steeply, very aggressively. Personally, I'm in that camp that some of these pressures are transitory, but what one has to worry about a little more, and what has driven the return patterns for the first 3 months of the year, is the fear of inflation. So actually, inflation is a long-term phenomena. What spooks markets is the short-term fear of inflation. And so the very biggest trend in the first 3 months of the year has been a continuation of equities up, and within equities, small cap equities, cyclical stocks and value stocks, by which I mean those that are most economically sensitive, those that are judged to be most sensitive to economic growth. So if economic growth goes up, the stocks that typically follow are those that have most gearing, most leverage into that economic recovery. So not the utility companies. My water bill and my electricity bill doesn't go up very much if the economy is up or down, whereas perhaps my personal consumption might, quite honestly. So it's those stocks that have really done particularly well. The UK is a combination of those factors. So the UK has done particularly well. It is a cyclical market. We have lots of miners. We have lots of oil companies, as was noted earlier in the meeting. And we are a value market. So the UK has been the best performing market really over 3 months. The corollary of all that is the worst performing asset is government bonds. Depending on what's called the duration of your government bond, depending on how long the maturity profile of your government bonds have fallen anywhere between 5 and 8% on average over the first Q1. That is a very big sell-off for what is supposed to be your defensive portfolio. Now, there's a double-edged sword for yourselves because your liabilities are matched against government bond yields. So actually bond yields going in that direction is a good thing for your liability profile. I would suspect it swamps perhaps any gilts you hold elsewhere in non-Brunel portfolios. But nonetheless, you've had a real demarcation in markets, bonds and defensive assets down, equity, risk assets, and within risk assets, the higher risk ones doing very, very well. The other trend to mention, which has been impactful on the portfolios, is that within equity markets, there are something called factors. And I don't wish to teach you how to suck eggs. We talked about this briefly at the last meeting. There is a distinction between those stocks that are growth orientated and those that are value orientated. So growth you can think about as being your Amazons, your Googles, your Zooms of the world. And value stocks at the minute are energy companies, financials, and some of those cyclical stocks that have been in the doldrums for really a couple of years, certainly since the pandemic pushed us back into our houses. We have seen a dramatic reversal of that trend where growth stocks have come under pressure and value stocks have started to have their day in the sun. And I say those things because all of those things have ramifications for when we go on to talk about your portfolios. So the fact that energy companies have done very well, the best performing sectors this year to date, are energy, so oil companies, material companies, so mining companies, and financials. The three worst sectors, if you're thinking about, were largely the three worst sectors if you're thinking about having an ESG overlay, because obviously energy companies, it goes without saying, Mining companies, well, that isn't too good for the economy either, of the environment either. And banks, interestingly, are the funders of both of those two sectors. So they are the facilitators, the enablers. And I would very much agree with the statement, Councillor Canning, that you made up front, that engagement is the right way forward. And you saw that actually very recently with Shell in the Netherlands being legally chastised and told to put the right targets into their company forecasts in terms of how much they are allowed, what their emissions are allowed to be. They were hard coded by the courts. Now, clearly, they will challenge that, but it's a step in the right direction. Exxon, their board changed from investor pressure. Now they've got two non-Exxon people on the board who are pressuring them to again change their practices, because Exxon, to me and to Faith, who's their responsible officer, are the laggards in the industry. They have shown very little inclination to change. And so those are the ones that we threaten with a disinvestment stick, because the engagement hasn't worked thus far. But now we have the community has got seats on the board. So pressure does work. Certainly the pressure that's being brought to bear at this stage of a societal awakening, if one wants to call it that, with regards to net zero and the timeline that was obviously just discussed in your neck of the woods, a little further in Cornwall, clearly over the last couple of weeks coming right up the agenda. So that's the backdrop. I'm sure you're aware, over the quarter, you added to small cap equities, the Brunel portfolio, you added to the sustainable equity portfolio, and you added to your emerging market portfolios. I can only see what came in. I'm sure there were things that had to go out on the other side, but those are the trades that I saw on my side of the ledger, and we'll just touch on how they worked as we run through the presentation. So on slide 13 of your quarterly deck, you can see how you are split today across Brunel funds and your legacy portfolio. I intend to tackle the biggest and the baddest, so to speak, given the time we have available today, and touch on the main themes that ran through everything. But of course, if there is anything you would like to discuss, please bring it up. I will also focus mainly on the active holdings, because your passive holdings have done exactly what they said on the tin. They have tracked the index. And so there isn't really as much to say about those portfolios as there might be around the active portfolios. So slides 16 and 17 goes on to a summary of those active portfolios and how they performed over the quarter. So we can start there. And I'll just pause there so you can have a look if you have it up. And then we will go to slide 29, which is the first active portfolio, past all the passive ones. But as I say, if you'd like to talk about passive, we certainly can. But they have done what they were intended to do, as you can imagine. So slide 29 is the diversifying returns fund. So as you might be aware, this is a cash plus mandate, i.e. it isn't one asset class, it's a multitude of asset classes and risk premia designed to provide a return of between cash plus 3 and cash plus 5 in order to be a building block for your other parts of your portfolio. It is also designed to be relatively defensive. As you can see on the slide, or if you don't have it in front of you, I can tell you that the portfolio was down 1.3% over the quarter. And what I told you at the top of the meeting largely drove that. The fact that government bonds were down 6 or 7, the Japanese yen was down. Most defensive assets in Q1 were down because of this rampant optimism about the future path of both inflation, but of the economy, which continued to get confirmatory signs that we were moving in the right direction. To bring it right up to date, the portfolio as of last night was up 5% year to date, so a significant recovery in Q2, which puts it up over 6% since the fund was launched almost 12 months or so ago. The good thing about this fund, you are occasionally going to get periods where the fund is down. It is supposed to slightly yin when your other assets are yanging. It is there for correlation purposes. It is there for diversification. It is there to grind out a return. Councillor Roberts, I can see your hand is up.
Yeah, sorry, it may be me, but I can't find numbered slides. I've only got pages in my report.
Oh.
And I wondered if you could possibly add the page number as well, David.
I can certainly. So I've got page 29 on the report I'm looking at.
Would it be helpful to if I shared it on the screen? I'm happy to do.
Potentially. I mean,
Page 29 is I've got as the Diversifying Returns Fund.
Exactly.
Yes.
Yeah, so that would be really helpful if you gave the page number. Thank you very much.
Excellent. I think, Catherine, maybe keep it off the screen so we can all see each other. But if you councillors and members, if you would like it on the screen, very happy to put it up. But it's more of a visual aid, so you can make a note and go into the fullest report at your leisure, should you wish to. So that was that fund. Little bit of a disappointing return, quite frankly, in Q1. But as I said, when all defensive assets are down, a defensive diversifying fund might struggle a little bit. And actually, the main subtractors of performance were their holdings to government bonds. But as I said, government bonds down anywhere between 5 and 8%, depending on which region you're in. And if you're at the very long end, with a long maturity, actually they were down more like 15 to 18%. So a real big sell-off, as I said, in government bonds. But pleased to say, in a world since the end of March, where markets have been a bit more normalized, because that Q1 was a snap, really. A snap down in government bonds and defensive assets as inflation fears started to become to the fore. So moving on to the next one, which is page 32, and it's the Emerging Market Fund. You can see the fund itself was up 2.1% against its benchmark, so against EM equity markets more broadly, of 1.4%. So an excess performance, so performance above and beyond, as you would hope for in active management, above and beyond the benchmark portfolio. It's a 3-manager portfolio. 2 of the managers did well, one very well, and Wellington were a slight detractor. Again, in an ideal world, very easily to say, but you'd like all 3 managers to be hitting the same, to being above target. But what is very important, you want them to be driving their returns from different sources of alpha. So actually 2 out of 3 for me is okay. It means we have a reasonable balance in the portfolio. Again, you want the funds to act in different manners, in different ways, and have different sources of return drivers from them. So a pleasing return. It means over the year that fund is up 46% against a benchmark of 42.8%. So a good absolute number. I will caveat these numbers are huge, but that is because we're looking at March on March, and that it was almost the low of last year. And obviously we have rebounded a lot since then. So I'd love to be able to say I'd come and talk to you about a 42% return every quarter, but my instinct is that sadly that probably won't be the case. So a good clean set of hills against the benchmark. If I can move you to the next one, I should say all the way through these reports, you will see the weighted average carbon intensity metric, which is what Councillor Canning was alluding to at the beginning of the meeting. In every instance, well beneath the benchmark because of Brunel's approach to running money, which is, I think, again, pointing your clients, pointing your members and members of the public to these numbers is very useful. You have already come such a long way in your Brunel portfolios to be moving towards net zero. We have a target for what it is worth for all of our funds for a 7% reduction every single year. And so we are well ahead of the market in this regard.
Can I just follow up a question on that, as you raised it at this point? Obviously, you're giving the figures per fund. Is there anywhere it's easily accessible where the figures would be for our entire portfolio?
My answer, I'm not sure, because lots of your assets are still outside of our control.
Sure, sorry, I meant the ones that you're managing on our behalf. Yeah.
Oh, I see. Do you know, I could put that together for you if that was helpful. Absolutely, we are.
It might be worth recording it somewhere, because as our investments switch and move around between funds, as well as what the managers are doing in each individual fund. So 1 or 2 of the questions that we had were specifically related to what actually happened in practice, what were the actual numbers, sort of thing.
Yep. Absolutely. I mean, what will happen and we've got some funds launching soon that you've been party to. As more and more of your assets transition, there'll be a big line, because it will largely all be Brunel at one stage, well, give or take, hopefully. And then the whole report will be, you'll have a top line number as well as an individual number, but absolutely. Catherine, do you?
Yeah, I was just going to add that pages 16 and 17 of the pack do give you the assets under management for each of the portfolios, specifically to Dorset, as at the end of the quarter. So just
if I know, I'm sure I could get a calculator and work them all out individually and put them together, but it would be useful if it was an automatic report.
Okay, fine. We'll take that away.
Thank you.
On page 36, you can see the Global High Alpha Fund. This is one of the funds that launched earlier in your transition to Brunel. You might remember it was the one that was up over 10% in relative terms last year, driven largely because it has a growth bias in the portfolio. So this is why I was mentioning those macro headwinds. When growth has suffered a little bit and Amazon has been a little less successful, at least in share price terms, and Tesla and the likes, the portfolio has come under some headwinds. What I'm very pleased with is I have a general philosophy about investments, and it's about creating asymmetry. If you can create asymmetry in your portfolios, or indeed your life, if you can get more of the upside of life and less of the downside when it presents itself, that is the route to success. That is route to what I call compounding. So allowing your returns to compound and compound rather than go up and down and up and down. You want to build on the foundations. So it might sound a little cheeky to say, so I will certainly take the slings and arrows, but I was quite pleased that the portfolio in this instance was up 3.2% and only behind the benchmark by 0.9% over the quarter. As you can see, by the numbers beneath that, it has still managed to capture and keep hold of the lion's share of the returns that it generated in excess of the benchmark for you last year. Now, a couple of interesting points and perhaps dinner side points. One of the reasons it was able to do that, you might remember Baillie Gifford, very successful manager in your portfolio last year, up over 80% in all of the right stocks, had a huge tailwind to it that has subsequently reversed. Well, we Brunel trimmed some of Baillie Gifford at the beginning of the year. So that helped because they have come under pressure this year. They themselves trimmed some of their bigger, more successful positions. So at one stage, Tesla, which was up 400% last year, was a 10% position for them. It is today, I think, a little over 6%. So there are layers of governance here and layers of action that can be taken to help create that asymmetry. Firstly, clearly, it is the manager. They captured the upside. What did they do when those stocks started to look expensive? They reduced them. So that was a plus in their column. We then reduced Baillie Gifford ourselves because we felt, again, it's gone a little too hard, a little too quickly. So again, it's about locking in those gains to a certain extent. So Baillie Gifford will tell you that they will only invest in a stock if they think they can see the potential for it to go up 5 times in the next 10 years. Usually they are very sticky with their holdings. They hold them for such a long time, and they probably will with these holdings. But given the run up in some of those names last year, the Amazons, the Apples, the Teslas, even they felt less conviction that they could get a 5 times return of their money. So they started to reduce back their positions, which meant when the turn in markets came, they were much more protected than they had have been otherwise. The other 2 things that happen in this portfolio, we have a dedicated value manager called Harris in the portfolio, and they provided the engine in Q1 when value stocks, as I mentioned at the beginning of the meeting, were those that were in favor. So Harris had been a manager that had struggled for a while because value was out of fashion. It is up over 10% now on a 12-month basis in relative terms. So again, building those portfolios with growth because of their sustainable bias, but having a value bias to it really provides that diversification. And it means when markets do turn as aggressively as they have done, we can hold on to most of the good gains that were built on last year. Actually, to bring you right up to date, that portfolio is now up in relative terms year to date. So not only has it held on to all the gains for last year, it's actually managed to increase a little bit of the gains this year. But really the plaudits always seem to go to Baillie Gifford because their number was so big. For me, the hardest working manager in this portfolio is Royal London, who are a core manager for us. They're a 30% weight in the portfolio. They have managed to outperform successfully in both market paradigms, the growth and the value. So actually, whilst they're a little underneath the radar, to do that in this environment, I think I think credit is due. Obviously, they're not on the call, but credit is due to them. They have been the driver of that stability in the portfolio.
Councillor Wharf.
You've got Howard Legg, I think, who was before me.
Howard?
You might be on
mute.
Legg.
Sorry about that. I get mixed up between Zoom and Teams and press the wrong button sometimes. You did make a comment just now, which I think probably needs at least clarification because it concerned me a little bit. And that was that when the comparison between benchmarks from these active funds goes negative, you are actually pleased to a certain extent. And we're referring to the Q1 with the high alpha one. If it's a benchmark, surely we should be performing in the same way as that, i.e. when it goes up, we go up, and when it goes down, we go down. You're trying to outperform it. Well, being negative to it is not outperforming it.
No, let me clarify. So the benchmark is the yardstick by which we will be judged. What I mean is that let's say the market's up 10% for argument's sake. Yes, I would very jolly much hope two things would happen. A, we would be up in the same direction. To be down would be awful, as I think you're pointing out. And then it's about how close are you to that 10%? So are you over 10%, which would be an outperformance of the benchmark and a realization of the reason you're employing active managers. But I have to be, and Catherine is too far away to kick me, but when I'm a super candid person and I want to manage expectations. There is not a world that exists where every day, every quarter, every month, performance will be above benchmark, because the market is an uncertain one. What we hope to do is over time after 3 years, 5 years, 10 years, be significantly above the benchmark. But there'll be times in that journey where you will dip either side of that benchmark. So last year, with full hindsight, I just wanted to be fully in growth. This year, with full hindsight, I want to be fully in value. Now, one can't make those decisions, like you can't run money like that. You'll get sideswiped and caught out. So I accept that there are some managers in the portfolio that will have a negative to benchmark experience. So they will still be up, but they might be negative to that benchmark in certain environments. And in that situation, I hope I've built a good enough portfolio that they have captured most of the upside when it was present, less of the downside when it was present, when the headwinds are there for them. And so that over the 12-month period, or the 1 year, or the 3 or 5 year, they were up in aggregate. But I have to be honest with you, if the benchmark's like that, there will be yings and yangs, and the aim is to end up above over time. And that's just being super honest with you. Anyone who tells you they will always be up, and I've run money for 25 years, and I'm afraid maybe I'm an oddity that I've never achieved it. But anyone who says they will always be up, I would take out and shoot, quite frankly. So I do expect
they might be called Bernie Madoff or something like that, mightn't they? Yeah.
There is a bit of that. So I do expect occasionally there to be, and this has been such a change in regime, quite frankly, because of coming out of coronavirus and going in was such a shock to the system, that some of that will lag a little. But as you can see from the global high alpha performance, we are still up well over 10% over 12 months. So the small underperformance we suffered in Q1, which has already been erased, I do expect those small lumps and bumps over time, but we would expect absolutely that we beat the benchmark over a slightly longer time horizon as we have.
Maybe you didn't ought to say you're pleased to see below par in Q1, but you understand it has to happen more.
That's probably a semantic. That's probably a better way for me to express it. Yeah, pleased is, yeah, that's fair.
Councillor Wharf, did you have a question as well?
I did. It's a more general policy question. My view, and it's a personal view, but I've a fair bit of experience in this. My view is that the mixture of the massive increase in money supply over the last few years and the Keynesian growth that's taken place in terms of pumping money into the system for projects, etc., I've every belief that it will work, but I think it will have consequences that take some time to come into effect. And my own view is that one of those consequences is that we will see what I believe will be a very major spike in inflation in between 12 and 24 months. If I was to put money on it, which I will be, it'll be about 15 months, and I can see inflation going through the roof because there's very little you can do to control it when you get past the event and it's a response to effects. And we're already seeing actually major increase, these are proxies, I know, but major increases in wages of hospitality, house price increases going through the roof. What my question to you, David, is whilst I'm not asking this committee to say, well, that's bound to be true, let's do something about it. If you believe that's a major possibility, what steps are we going to take to at least hedge or at least cater for that in the total Brunel portfolio for great inflation increases? What is it you're suggesting that we do as a series of measures? Thanks.
So not at all. There's one thing. There's one point to make, and then I'll address your question. Inflation could well be higher in 3 months, or sorry, in 1 year or 2 years or 3 years than it is today. Markets are reacting today. This is the way. There's a mechanism. By the time you're absolutely right on two fronts, you're right. By the time inflation comes into the numbers, it's too late. It's embedded in the system. It's on an upward trajectory. It's a tanker that is very difficult to turn.
Yeah.
The other point, though, is markets are reacting today to the fear of inflation. So actually what one needs to do, I do as a market participant, is weigh up what is priced in today and what is likely to, and what are we likely to end up with. And actually today, the markets are pricing in quite significant bouts of inflation, precisely to your point. So there are a number of things in the portfolios that are useful. Firstly, is that you are in equities. So for most of your Brunel holdings are today in equities. Equities have more inflation sensitivity. Clearly, they are real assets. They grow with inflation. It can definitely upset the apple cart there. And actually, on our website, for those of you who are interested, I've just written a piece about inflation and the ramifications of it. The other kind of side issue is that inflation can be better in the short term for value-based stocks because it might push up interest rates. This is really the debate, where the debate should happen. It's not whether about inflation goes up, it's whether the central banks decide to increase interest rates. Because if they do, there is a very big debt burden out there that becomes quickly unsustainable because, as hopefully none of you have experienced, but certainly people in the UK have, that you can afford your mortgage at low rates. You can't afford your mortgage at high rates. Same for corporations, same for government. So that's the conversation. So actually looking at your portfolio as it's based in aggregate, not just the Brunel bit, you are quite heavily skewed to what I would call real assets. So that is a first positive step in the right direction. All of the things you have with Brunel today are real assets. You do have some nominal assets, but you want to build a portfolio that has diversification. So it's not so much what I can do within the funds, actually, because every manager we employ is thinking about inflation, seeing the ramifications on its companies, ensuring that its companies can pass through inflation to keep its profitability. There are a number of companies that obviously can't, ones that have regulatory caps, et cetera, et cetera. So I'm very confident our managers are doing it. At the top level, clearly, you have as a pension fund inflation sensitivity, which is, so I would perhaps, I don't want to step on any toes, but perhaps one wants to ask maybe Ellen or your advisors what you're doing about inflation hedging. But all I would caveat is that the market has already adjusted to a higher inflation regime today in the consensus opinion that it will come through. So a lot of the heavy lifting, as it were, by asset class has been done, and that's why bonds are down so significantly already this year and commodities so significantly up.
So Alan, do you want to come in there?
If I can just comment briefly, one of the questions I raised in my commentary is inflation good or bad for equities? So very much germane to Peter's opening remarks there. And my conclusion is moderate rises in inflation are quite acceptable. Markets can cope with that. But when we start talking about a wage price spiral, such as we've had in the UK many times in the 70s and 80s, then equities do tend to suffer quite badly because of the central bank policy response. So that's something to be looking out for. I mean, we just had this shock 5% US inflation report in May. That was much ahead of expectations. If we keep going on and wages start to respond, then equities will be getting quite apprehensive, I think. For new councillors, we do have something called an inflation hedging strategy with one of our other managers, where we hedge out about 30% of our inflation risk. And we do have the opportunity to increase that at the moment because the leverage has fallen back. I'll discuss that later on, perhaps. Thank you.
Okay. Councillor Christopher, you have a question as well?
Yes, a couple of points, perhaps. Earlier this year, we saw falls in stock markets. The share prices have generally been good, but we all know that share prices can go up like escalators and down like lifts. And we've seen situations where, certainly in America, the market went down dramatically because of concerns about inflation. Are we going to see much more volatility this year? And in answer to the previous speaker's question, do you have any particular comments on a rightward move of the Phillips curve, i.e. we've long been looking at low inflation, low unemployment? Are we going to be looking at higher inflation? And because of technological change and general change as a result of COVID and the fact that a great many people are going to be affected by technological change and we can't all retrain as builders, etc., are we going to see a rightward shift in that Phillips curve and higher unemployment and higher inflation?
Yeah, so if I take your first question, I think volatility is ever present in markets. Sometimes we just have periods where we forget it's there, quite honestly. And it depends how closely you watch markets. From quarter to quarter, things can look super unvolatile, but within quarters, as you rightly point out, you can get sell-offs. And that's exactly the point of that diversified return portfolio that we run for you, to try and dampen down some of that. And I suspect some of the work that David has done at portfolio construction level with Alan and others is exactly to dampen down some of that volatility. But yes, my personal view is that I would suspect at some stage we would get a return to a higher level of volatility. You may remember post the global financial crisis, actually volatility all but disappeared. It really did. It used to run at a number called 18 and it was running at more like 7 and 6 at some stages because it was being suppressed by the government and by bond buying. The biggest shock to the market will come when either Jay Powell or whoever his successor mentions reducing tapering. So when the government starts stepping away from the medicine that they have provided to the economy and to the markets, that is when you will see a big reassessment of the volatility regime. So I think that is entirely possible, not for the short term. I don't think they're going anywhere in the next 12, 24 months, but at some stages, yes, they do have. I would like to see them step away from markets and allow the patient to live without medication. The Phillips curve, I know, Alan, you're an economist, for what it's worth, my view, and I hope we disagree, because if we both agree, we're probably both wrong, I've always found. But there's been so many articles written about the disappearance of the Phillips curve and the disappearance of inflation. And obviously there are lots of short-term factors that we've talked about. Obviously there's long-term factors as well, which are often forgotten, which mechanization is one of them. Demographics are another. The reason we've been in a disinflationary world for a while, to my mind, is because we have had an abundant supply of labor from Eastern Europe and China flocking globally. And globalization really was a disinflationary trend. As that disappears a little, or at least stops growing, as people start to bring their operations back onshore, there will be a little bit of inflation. There are certainly bottlenecks, but demographics is a big one to move. So you might get a shift, but I'll be interested to see what Alan says here. But for me, it's not about whether you get it or not. It's about what's priced in. Always markets move, not on what happens, but what is priced in today. And I think that's really an important point to remember as one discusses these things.
Yeah. Councillor Roberts.
Thank you.
Yes, thank you, Chairman. It's really more of a sort of rhetorical one. With the very rapid rise in commodities, particularly in metals and things like tin and the shortage in China, and even the Italian tomato industry suffering, how agile are we to move in and out of possible gains, and how does it conflict with our avowed sort of carbon footprint policy when actually we need to make money for our pensioners? And which tops the other?
So I would suggest that they aren't mutually exclusive. You can have a sustainable program, and you can fulfill your financial fiduciary responsibility. Because actually, I mean, we spend hours talking about this, but when one thinks about stranded assets, let's just take the oil industry. The International Energy Agency, you may or may not have looked at, they produced a huge paper. It was all over the FT at one stage. They came out much more bearishly than anyone had expected. They'd obviously been writing this report when Trump was there. They couldn't release it when he was there. The moment he stepped down, out came the report suggesting that energy demand will be hugely reduced, further than anyone was predicting over the next 10, 20 years. So to get to net zero, we're seeing that you really shouldn't be embarking on any new E&P, so exploration and production businesses. So some of these companies are looking at a very, very bleak future. Some of them, however, the bigger ones with the balance sheets, will be part of the transition program. I have no doubts that Shell will exist in some description, in some manner, as an energy provider 10, 20 years from now, but it just probably won't be as aggressively in the oil business as it perhaps is today. So I don't think these things are mutually exclusive. When one looks at a company, again, a bit like inflation, the first thing you do is say, what are the prospects for this company and what is priced in? Because I could predict the earnings growth for any company and still lose money if that company wasn't valued appropriately with that margin for safety. So I don't think one has to worry about, do I choose one route or the other? I think they're not mutually exclusive. I think you can make good money. We can beat benchmarks. The only thing is, again, those pockets of lumps and bumps along the way, and we're having one today. Again, the oil price is very aggressively up this year, and even more so over the last few days. That will cause a little bit of short-term pain, but I do believe that is short-term pain because the transition is very much underway, and other companies are coming to fill that void that is left in energy production.
Okay. Councillor Christopher, is that the same question you're indicating?
Yes, just to follow up, since you mentioned oil companies, presumably what you will do, because you have an environmental brief, is that you will follow signals from the companies as to what are their overlying desires, i.e. if we go back some 15 years ago when Lord Browne resigned, there was a move with Tony Hayward perhaps away from alternative energy at that point towards concentrating on safety because of all their mishaps. And you will presumably follow those signs and those signals. And if necessary, if you had a holding in BP in this example, consider moving to Shell in this example in order to mirror the market and focus on our desires to achieve net zero carbon.
Yes, what is very important to us is that these companies have realistic science-based targets to achieve their transition. And the industry and the analysts and the fund manager we employ and ourselves will be ensuring that they meet those targets, because now there are very firm targets for lots of these companies. And that's where the disinvestment stick comes up. If people aren't hitting their targets, if their targets aren't aggressive enough, if their targets aren't aligned to Paris, then that's when the threat of disinvestment can loom as a spectre, because what you can measure, you can monitor and manage. And we now have moved into a world where those targets are very much embedded in how those CEOs and boards of oil companies talk.
Thank you, David.
Thank you. Perhaps we could move on a bit. I'm conscious of the time, so.
Yeah, I'm very cognizant of your time. I know my time is almost up, so I shall speed through, but I don't wish to do you a disservice. So the next fund is sustainable equities. The fortunate thing here is that the rhetoric is the same. Actually, this fund was further behind its benchmark, 3.3. The reason being, relative to the Global High Alpha Fund that had that value strategy, this fund does not. It's a more pure play expression of sustainability. All of our funds have an ESG overlay, as you're very much aware. This one goes a step further and invests in companies. It doesn't just avoid companies, it deliberately invests in companies that are seeking to change the world, change the way we do things. So they're investing in solutions as opposed to avoiding some of the other sectors. And this sector came off the boil, quite frankly, having been up so aggressively over the last 12 months or so, came off the boil in Q1. So you can see the fund is still up 0.4, but beneath its benchmark. Sorry, this is page 40, I should say. Up 0.4, but behind its benchmark of 3.7. So a weaker excess return here. Again, I'm not pleased with this one, to get my language correct, but I do understand the headwinds it has faced, and I suspect these will dissipate as we go through. But when oil really stands on its tail like that, that'd be are up 3 times the average market benchmark. This is a side effect, but those trends do not last. And I'm pretty confident actually we can continue to move ahead in the right fashion in this fund.
What actually is the benchmark for this fund? Just remind us.
It's MSCI. So it's MSCI ACWI, which is the basically a global equity benchmark, including emerging markets.
Right. Okay.
So it's the same benchmark as Global High Alpha for consistency.
Right. I mean, an alternative there would be to use the MSCI. Do have a sustainable benchmark, don't they? It's a sustainable index.
It's interesting you should say this. We have, I think I can talk about this. We have been liaising over the last 6 months with all the indices providers, giving them our experience, working really in partnership with them so they can provide something that is useful. Because quite frankly, at the minute, not all of them do. And even if they do, they're not quite how we would like them. So Faith Ward and our team have been liaising with all of them. We are close to formalising something with FTSE Russell, who we believe are a better provider of sustainable indices. And we have worked with them to ensure that they are creating Paris-aligned benchmarks and climate-aligned benchmarks that are useful but pragmatic. And then we will start to talk to your client group about rolling these out into these funds so you can measure what's called the basis risk, the difference between a Paris-aligned benchmark and a market cap benchmark. And then you'll be able to slightly judge it a bit more appropriately, and remove those biases that exist in the portfolio.
Okay, Alan?
If I may just come in here, I would express some reservation about adopting a sustainable equity benchmark. This is a strategic decision we've made to move away, if you like, from conventional equities measured by the Morgan Stanley Index. We require a rate of return of at least 5% from all our assets. We probably assume a return of 6% from equities. If there is going to be sustainable divergence between a sustainable portfolio and a conventional portfolio, we wouldn't pick that up. And yeah, so the fact that we've underperformed 3% quarter one, this is 10% of the overall portfolio. So that translates to 0.3% underperformance at the aggregate level, which is most of the underperformance in this quarter. So the same as with our smart beta portfolio, David, where you use the smart beta index, we're not really comparing like with like here. And I would like us to show wherever we have global equities to have a consistent standard benchmark so we can make proper comparisons.
Well, I think I understand where you're coming from. There are two. Firstly, that we wouldn't change anything without agreement from the client group and from yourselves. This is a suggestion. At first blush, we're setting up new passive portfolios, and then those who wish to transfer into them can. Those who don't shan't, as it were. And then we will discuss rolling them out, perhaps as a secondary benchmark. I mean, we firmly believe, and I suspect somewhere embedded in your belief system is a similar thing, that being sustainable does not mean you impair your return stream. Actually, quite the opposite. So I think, I don't know who you use for kind of long-term forecasted returns, but I would suspect that if you use a global sustainable index and a market-weighted index, you would not see a degradation in the beta of that benchmark. All we would like to be able to show you is the impact of the decision that you have taken to move away from, to put this bias into the portfolio slightly, and then it can be measured and managed. And we can, and then actually for you guys, it will allow you to really much more accurately judge me. Because Baillie Gifford is a great example. It was up 80% last year. That wasn't all skill. That wasn't all skill. They caught a growth tailwind, which did at least 60% of the heavy lifting for them. So the skill was them outperforming the growth index. And so by slicing and dicing, it gives you more transparency. And it might not even be a replacement we suggest. It might just be having the two alongside, so you can measure and monitor the the divergence when it occurs, if it occurs, and actually over time we suspect it wouldn't occur as the world completely moves down this route, quite honestly. But it will just allow you to show what is a secular decision you've taken, and then what is the true alpha that's being generated by these managers.
Okay, thank you. Councillor Christopher?
Merely to say it's very difficult to gauge the correct thing to do, whether to actually invest in the share market or directly to invest in infrastructure. The position for ourselves as councillors is a bit like reopening a freight railway line and then realising what you've done is you've reopened a freight railway line and then you're going to put diesel trains on it when you should have electric. i.e. So we really need to be governed by environmental matters on everything that we need to look at. What we are certain is that when life does return to normality, there is a natural inbuilt desire of people to travel, and therefore, that's why perhaps we should be looking at infrastructure more and more. And if infrastructure is backed by government, is that a genuinely safe bet?
So we have across everything Brunel runs, and we have, as you're probably aware, infrastructure funds as well. Everything is skewed with an ESG lens to make sure we are in fact, our infrastructure funds, two of them are renewable only infrastructure funds, and even the general infrastructure funds have the same ethical belief or philosophical belief running through them. So I wouldn't disagree. It's for you to say how you split your portfolio. I would always advise to keep equities, but also to have infrastructure and private equity and all the other things, so you build a diversified portfolio. But the more and more you transition to Brunel, that is going to runs through everything like a stick of rock. So again, one doesn't have to choose one portfolio over another. Those same principles will run through indeed everything we do. The only thing I would say about UK infrastructure, and this is perhaps a side point, is we are badgering the government because they haven't made the type of projects available to UK investors that we would like to see. They have been selling things off elsewhere at at levels that are somewhat price insensitive, and they haven't come to the LGPS community as they would like to, and pulled us around the table. So we have written as chairs and CEOs of all of the LGPS community to the government to say, please invite us to the table when you're discussing infrastructure products. You would like us at the table. We would like to be at the table. Can we please create a forum to do so? So those opportunities we would hope that haven't presented themselves in UK space begin to, if the government listens. Now clearly that's a big if.
Okay, thank you again.
Thank you, David. Could you now whiz through the remaining ones? Sorry about this.
Not at all. If I go to, small cap portfolio, you put in your money and it had 10 days. So I should probably skip over that one. The one you've had in for longer, I'm going to take you to page 48, I beg your pardon, which is the UK equity active portfolio. So again, it was up 4.6% over the quarter, slightly behind the benchmark of 5.6, so 1% against the benchmark. This is where actually more aggressively being underweight energy and banks shows up, because obviously the UK market is BP, it's Shell, it's Barclays, it's you name it. It's a much more energy and financial market. But again, what you can see is that over the 1 year and even since inception, it's kind of kept its nose clean and ahead of the benchmark. The other thing to note here, as I mentioned very early on, is that the UK was the best performing market, so up 5.6% over the period. Somewhat that is because Brexit, I wouldn't say is closed, but obviously in Q4 we climbed over another hurdle, and clearly the arguments go on. But the other interesting thing to note, which will have impacted your returns elsewhere, is that sterling has been rallying. So the pound has been rallying. If and when you go abroad this year, you'll get a little more for your money. That has meant that international investors can come back to the UK with a little bit more security, knowing that the pound isn't going to collapse and fall out of bed, which makes it a very painful experience for them. So that lack of investor interest, which has been there really since the referendum in 2016, is starting to dissipate, and we know that international investors are starting to return to the UK shores. So it's had everything in its favour. It's a highly cyclical market. It has banks, it has miners, it has energy companies, and then it's been the best performing market. And we have lagged a little bit in that high beta cyclical rally that I discussed earlier. But again, what you can see on the next slide, 49, sorry, not 49, I'm going to come down to it. On 51 is the weighted average carbon intensity, again, significantly reduced relative to that benchmark positioning. So just to ensure we are, I say we're underweight energy, you can really see it coming through in these portfolios.
Mm-hmm.
I shall draw up stumps there because that was really the last listed portfolio.
Okay. Councillor Beasley.
Thank you, Chairman. Just a very quick response to David about the point raised a moment ago concerning the pool's approach to government with regard to infrastructure investment, something I think that we've long hoped might be progressed. All I was going to say was that I think there may be a role for the Scheme Advisory Board in here to put a little bit of pressure on the government also from a different angle. And I just wondered whether, David, you might want to speak to the chair of Brunel, Denise Le Gall, to promote that on behalf of all the pools, but on behalf of Brunel in particular. She'll know how the Scheme Advisory Board works, having been formerly a member of it. And I think that if we're to develop infrastructure in the way that I think the LGPS would like to, that is working alongside the government in a very proactive way, we need to establish how a secondary market will be developed, because investments won't be wanting to be held forever by the pools, nor indeed by funds generally, and that is the part that the government really need to get a grip on. So if you could take that away, I think that might very much be to our benefit.
Yeah, it's already done, Councillor. As you know Denise very well. It's I have to rein her in rather than anything else. She's very much on the front foot with this one. So that is already logged and in progress.
And I will advocate for it at the Scheme Advisory Board as a response to that.
Thank you.
Good. Any further questions for David? Well, thank you very much for that very thorough. Oh, Alan, sorry.
Yeah. Alan has his finger up there.
Yeah.
Just an observation, if I may, for the benefit of councillors, that to give them some reassurance, I do think that Brunel are doing a pretty good job here across the spectrum of the funds that David has just reported. I know there have been occasional misgivings along the way, but I think now that everything is looking pretty good. The diversifying funds portfolio, though, I would urge you to change your benchmark to cash plus 4% or something like that. That's what we have with Barings, who pretty well matched it over the time. And we do expect a return of 4 to 5% from our diversifying funds exposure. So a zero return, cash return, isn't sufficient. I know we've had this discussion before, but for the benefit of the councillors, I would hope to see a change in the benchmark there.
It's in motion, Alan. We have to go the normal hoops, as you can imagine, with all the clients to change these things.
But it's also gratifying to hear they are proactive with the managers. So they've reduced Baillie Gifford, an obvious call to make, but they had the guts to do it when Baillie Gifford were top of the pops, as it were. So, in conclusion, I think everything's looking pretty good.
Mm-hmm. Good.
Thank you.
Thank you very much, Alan. Right, well, we're on this part of the agenda, we'll talk about Brunel. Obviously, Councillor Beasley has a role with them, and I want to give us any update on what you've been working on the last few months.
Yes, certainly, Chairman. For the benefit of any newer members, I represent the Dorset County Pension Fund on the Brunel Oversight Board, and I work also closely with Aidan Dunn from Dorset, along with David Wilkes, in terms of other matters, whereby, as far as the shareholder meetings are concerned, we will make sure that one of us is available for those meetings too. And so I think it's a very well-rounded approach, and one where, having formally chaired the Oversight Board, I'm very clear about what its role is and what it's trying to perform to, as far as the individual 10 funds across Brunel are concerned. So in terms of an update, Chairman, just very briefly on the annual general meeting, which took place on the 25th of March, and I apologise that this is all historic. It's just the incidence of meetings with Brunel and with Dorset, we'll see this in a moment for the oversight board, where actually the timing is such that they're always going to be a couple of months behind the curve. I can't do much about that, but the annual general meeting, I think, is important to mention, and by agreement, I represented Dorset at that meeting, and both the chair and non-executive directors were reappointed. I think it's important that I mention that just for consistency. And to add to that, that then in the meeting of the Oversight Board, changes have taken place, and most especially, we are now fully up to capacity as far as the non-executive directors are concerned, where there are now 5 and there are 4 executive directors. So in line with best practice, the non-execs slightly outnumber the executives. And the other 2 new non-executive directors are Miles Geldart and Roly van White. I think I've pronounced her name correctly. She's of Dutch origin, but that brings us completely up to speed. And I'm very pleased to say that the non-exec directors now span, I think, a very wide range of experience and knowledge of a consistency which is going to support Brunel in its work, I think, extremely well. It isn't just a question of filling the positions. I know that Denise Legault chairing Brunel has been at great pains to make sure that those non-execs are absolutely the very best that we can get, and that we will therefore make sure that their role is properly performing against that of the executive directors. And I'm very comfortable now with the team we've got. And just for the benefit of the vice chairman, I think we've now got to a position where actually the changes have served us well. I know that there have been concerns about people coming and leaving Brunel in its earlier stages, but now there is stability, and stability with, I think, the right team in place. In terms of the issues that we dealt with at Brunel Oversight Board, I'll deal with these very briefly because I know time is tight, Chairman, but we spent quite a bit of time on the business plan for the coming year and the budget. And as you'll have seen earlier from David's report, we have established, I think, that Brunel has so far managed to engineer £30 million worth of cost savings. It's a little bit of an arbitrary round figure, I suspect, but it does give us, I think, the comfort that one of the principal reasons for going into pooling is already being achieved. And of course, as you'll know, there have been a number of startup costs involved to set against whatever we've been trying to save at the same time. But I also take comfort that the transition of assets is occurring in the way that it should. So I think David's report talked about £20 billion of assets being transferred. Bear in mind that the quantum of Brunel is expected to be somewhere just north of 30 billion. I think that's very, very good progress indeed. And what gives me greater comfort is that there were 2 components, 2 funds, which were, if you like, dragging their heels a little bit for different reasons. The Environment Agency in Wiltshire, and those since the end of last year have now picked up speed very considerably and shown that commitment by making sure that their transition progress is at some pace. In terms of our progress, I think we're up to somewhere approaching about 60%, and that is going along smoothly in exactly the way that this fund always intended it to be. So the other issues that we dealt with were very much around looking at the budget. As I say, the budget is 11.5 million forecast, of which in the last year we've had an underspend of somewhere over £100,000. That budget was I think, very well put together coming out of the shadow status of Brunel not that long ago, and is now within the budget that we had set them. We also looked again at cost transparency and value for money, and that combined with the savings that are being made, although not exclusively around that, again show very good progress. The issue of the governance review is something we've been looking at, and that I think has taken us more time and angst than we had anticipated, but I think we've now made steady progress to a position that all 10 funds are broadly supportive of, and I think it's now up to us to make that work looking forward, and perhaps to ensure that if there are governance issues out of that governance review, that we get a handle on them perhaps more quickly than we had in the past. I'm always reminding colleagues on the Oversight Board that we had to set this whole process up at some pace, and that we always knew that inevitably there would be things to come back and repair later on. And so it's turning out to be. Make no apology for that, but I think we just need to be sharper in terms of when we deal with those issues coming forward in the future. And just finally, Chairman, the appraisal of the chair of Brunel, Denise Le Gall, has been completed, and again was an item which was discussed and I think dealt with now in a very professional way, and looking forward, the whole issue of appraisals is one that we are very sighted on, in order that we can take the comfort away that not only is that best practice, but that if there are any improvements to be made, that we're addressing them with the individuals as quickly as we possibly can. Just finally, Chairman, to say that the executive team at the top of Brunel, and we've heard at some length from David this morning, I think time and again are setting the example across pooling in the whole of the country, and are on the leading edge of many of the initiatives that need to be taken forward in the future. A very high degree of professionalism. I think probably some of the best people available in the industry, and we should all take not only comfort from that, whilst of course all the time looking to improve, to sharpen up our performance, and to make sure that if there are any suggestions of complacency, they are put where they need to be immediately, because that team, together with the Oversight Board and the non-executive directors, I think, are holding the executive to account in a way that we would all expect, and that in turn will lead to better performance, better cost savings, and justification for pooling, which I know some members are still concerned about, but I'm always available, Chairman, should anybody want to contact me on specific issues.
Thank you very much, both for that offer and for the hard work you've been putting in. Are there any questions for Councillor Beasley? No? Okay, well, in that case, as that concludes our discussion on Brunel, and we don't have any recommendations. So, David and Catherine, you're welcome to stay with us if you want to. But equally, you don't have to, I don't think. So, it's up to you guys to decide.
I should take my. Thank you very much. Very nice to see you all.
Thank you. And actually, yes, nice to actually see you this time. I said yes. Thank you very much. Right, moving on to the administration report. Karen's away on holiday at the moment, so we've got Jim to present to her report.
Morning, chairs. Thank you. Yeah, morning, members. I've also got Steph Ball, a colleague from the pensions admin team with us, who's going to talk a little bit more about the systems implementation work. But if I pick up just 2 or 3 points in Karen's report, she's taken some very well-deserved leave. First of all, pleasing to note still the performance indicators for the pensions admin team at Appendix 1 of the report, still over 99% in overall performance of key targets. So very pleasing, particularly in current circumstances. Probably most importantly, there are 2 new policies that have come about for the committee's approval, please, and then they'll need to go forward to the Local Pensions Board for approval as well. Those both stemming from the amendment regulations for employer flexibilities. So Appendix 2 covers debt spreading and deferred debt arrangements and the processes for going through those and monitoring them for exiting employers. And the second one, Appendix 3, is the contribution review policy, which allows either scheme members, scheme employers, or the scheme itself to review in between actuarial valuations for potential triggers for changes in contributions. So those are the 2 that need a formal review. Just by way of context, there's also an update to the funding strategy statement that Karen's sent through as well, that I think David supported her on too. So thanks to those. And there's amendments to that are just to reflect the substance of the 2 new policies that you see before you. The only other point I was going to pick up specifically was the employer update that Karen has started to include those employers who are joining and those who are exiting. So there's actually one missing that we've noticed from the report as shared with you, which is Action for Children. And what we'll actually start to do in future is include what the exit credit or the exit debit arrangements were for each of those employers that are leaving, and the arrangements that they're putting in place to actually deal with those, some of which of course might fall within the new policy Appendix 2, but we'll deal with those in due course. So if there are any questions, particularly on those areas, happy to pick them up, or in particular cases forward them on to Karen, or otherwise hand over to Steph for a quick update on where we are with the
I think
system
Adrian's got a question
implementation.
for you first. Adrian.
Just very quickly, Karen said that to look specifically at time periods in there, and my only comment was that we've got some time periods which talk about 28 days and 30 days. Would there be a better clarity if we had 28 working days or 28 calendar days, just to avoid any issues in the future?
Yes, okay, I'll take that back to Councillor, and we'll pick that up and clarify it. But yes, if members are happy to approve, subject to those clarifications. So if I say now, what we'll do is we'll put working days in with those same numbers. So the drafts that came through were very much Barnett-Waddingham drafts, and we have discretion to use our own periods. They're not hard and fast. We will amend them and work flexibly with employers as and when those things happen.
Okay. Councillor Beasley, you got indicating a question, or was that from before? You got your hand up.
I apologise, Chairman. That's a legacy hand.
Okay.
Which has been removed.
Okay. Does anybody else? Yes, Mark Roberts.
Yeah, thank you, Chairman. Jim, are we given a reason why organisations are leaving the pension fund?
We generally are, yes, and in most cases it would be because they no longer have any employees who, well, the company itself or the organisation itself might be going into administration, might be being absorbed into another organisation, or they may not have any employees left who are part of the scheme. But in each case, yes, that information comes to us.
No, I didn't know if it was shared to members or whether that was more confidential.
It may well be. If there are confidentiality issues, we'll say that we can't say.
Okay, thank you.
We will only share what it's appropriate to share that's in the public domain.
I think we've had bigger issues with some clients in the past, and certainly we've talked about those issues individually. I was thinking of one of the bus companies in Bournemouth a while back. We had a discussion about them, but normally we as members don't get involved quite so directly with that.
Thank you.
Right, Jim, back over to you and Steph.
Thank you. Yes, so I'll hand over to Steph for a bit of an update, please, on the system implementation. Steph, thank you for joining us.
Thank you. Good morning, all of you. I'm Steph Ball, and I'm the Pensions Systems Manager, and I'm actually leading on the project implementation for the team. So Karen's given you some information in the report, but I thought I'd share with you where we are and why do we go to tender and everything. So part of the reason for go to tender is our current software contract was due for renewal on the 15th of August 2021. Then we received information that our case management system, and which also included the employer portal, was actually going to be decommissioned on the 31st of July 2021. And we received formal notice for that last April, which then forced us then to actually go down the full tender route, which you couldn't do a direct award with our current provider. So we went down the full tender route with the Norfolk framework, who dealt with most of it, really, with that side of it, and dwindling down, we left us with two providers, which was Civica and our current provider, Quiller Hayward. And a lot of what we were discussing and our scoring and everything was what was the most important for us with scoring and the procurement through it was 80% of quality of the system against 20% of the cost. And actually Civica outweighed our current provider, Quiller Hayward, for quality considerably and cost. So the contract was eventually awarded in November, which was 6 weeks behind plan, really, due to the resilience and questioning from our current provider. Procurement supported us a lot through that initial stage, which was really helpful because it was a lot of unknown to me. So that was really helpful. And where we are now is we were appointed a project manager who we work really closely with to ensure both parties fulfill their responsibility. A high-level project plan was agreed with Civica, and I created a subsequent plan for us to then ensure the team understood our responsibilities and deadlines, including our day-to-day work as well, with end of year hitting at the same time.
Steph, I'm very sorry to disturb you.
That's all right.
I've just checked with Aidan. The recording has stopped, and we record all our meetings for good governance, and I'm not clear why it stopped. So I'm bringing this to the attention of the chair and who is ever managing the meeting, because it should be recorded so that people can access it.
Martin is with us to do that.
Can I? Apologies, Chair and Vice Chairman. Can I just chip in there? I think what's happened is that Brunel were separately recording the meeting themselves. So unless Martin or Catherine say differently, I believe that the YouTube recording is still going out and still being recorded. I think Brunel were also making a separate recording. The reason I say this because it happened in March and it sent me into a bit of a panic, and which was an unfounded panic. So I think unless Catherine or Martin shout, I think we're okay.
Okay. But thank you for bringing that to our attention, though. But hopefully, fingers crossed, it's still working.
And I'm sorry, Steph, I didn't mean to interrupt.
No, that's all right.
Because you were doing a great job. And I'm loving Weymouth in the background.
Oh, good. That's all right then. Okay, so where were we? So we were at the project plan. So we agreed the high level, and then the team has got a subsequent plan that we follow, and they know all their deadlines and responsibilities. There's also a RAID log which identified any risks that might delay the project, and the actual go live date. There's also a highlight report as well, which highlights the high level of the progress of the project and everything. And at the end of May, we're 72% complete, which is good news, seeing as we're not that far off go live. Karen and I meet weekly with the project manager to discuss the progress and raise any concerns. So both the highlight report and the RAID log are reviewed on a monthly basis at the beginning of each month within those weekly meetings. IT, so Dorset IT agreed to host the system to maintain continuity because they host us with our current provider. I've been working closely with them to ensure all the servers and URLs are going to be in place for go live. And they will also be carrying out our pen testing for the members portal and the employers portal as well. So with UAT, 3 work packages have been delivered. So it's come in chunks to us, starting with the easiest part of the system to then building up. So we're now actually on the calculation side of benefits. The team are actively involved. And a lot of it covers all the system configuration, the bulk processing, calculation of benefits, and then just members and employer portal. All the tests that we're carrying out, all the UAT is being recorded to fulfill audit requirements. Dorset are audited on their IT every year, and I'm normally part of that with the current system, so we'll make sure we've got everything in place. So when we're audited next year, we've got all the answers they will require with regards to the implementation. And last 2 weeks, because we're getting so close now, I introduced a weekly meeting with the people doing the UAT to discuss any issues they're encountering, how do they actually feel about the system, and share any hints and tips that people may have found. So we are progressing fast. It's we're 6 weeks away, but we'll be fine. I've got every confidence. So the admin system actually goes live on the 28th of July. The employers portal will go live on the 30th of July, and the members portal will go live on the 2nd of August. Next week, we're meeting with our employers, and so we've got a subgroup that are willing to come in and do some UAT on the live database to get their feedback as well, to see how they feel about the change and how that system's going to work for them. So has it been easy? It's not been easy. It's been a challenge for the team, but we are meeting our deadlines with the project and the day-to-day commitments. End of year was completed in record time this year. Annual benefit illustrations have been sent to print, and they will hit the members' doorsteps at the end of June. Annual allowance has been run as well, so the team are addressing that alongside UAT, some of them. And the only other thing we actually did was due to getting ourselves comfortable with the system and understanding UPM a bit more and how that works as an administrator, we've postponed the payroll migration from Dorset Payroll to actually go live on the 1st of April 2023. And that's due to resource and time it's taken to migrate the administration system. So we thought it was the right approach, that we couldn't commence the payroll project 2 months after finishing the administration system, when there could still be some configuration that's required to tidy it up and get it working for us the way we would like it. So yeah, so we can enhance the system really to fit our requirements. We've got a lot more control of this system than what we do with our current one. Anything that we raise through Aquila Hayward has to go through a development plan, but we have a lot more control with the configuration of this system and can make changes as simple as changing names and things like that. So it works better for us. But yes, and payroll will commence, the project of payroll will actually commence October 2022, when we would have been using the system then for 14 months and have a lot better understanding ourselves. I think that's about it, if anyone's got any questions.
Thank you very
Can I
much.
just briefly before thanks Steph very much. Chair, I'd just like to echo my thanks to for Steph for coming and talking us through that today, but also for all the work that she and colleagues and the whole team have put into this. It wasn't something that we'd ever planned. It was something that we were suddenly given notice of, and we've had to do a huge amount of work in a very reduced period of time. So team pulling out all the stops and really doing some excellent work. I'm really grateful for it.
Thank you.
Thank you very much. And Councillor Roberts.
Thank you, Chair. Yes, lovely to have such a professional team and the way it was presented. I did notice in one of the reports about a relocation of the team and some issues. Will that affect your going live, and is there a reason behind this?
Jim, would you like that one?
Thank you. Yes, so I think it's fair to say that there would be an issue if the timing isn't right. So whilst we are still in conversations with Dorset Council as the host, which is doing a whole load of reconfiguration work around its buildings and its office estate. The pensions team will be moving at some point in the future, but we need to make sure that the physical move, the relocation, happens in such a way as it doesn't disturb the implementation of the new system or the timeline around all of the work that are required to bring those systems online, as Steph has outlined. So the administration system, employer portal, and so on need to dovetail all of that really carefully.
Yeah,
we're still in dialogue.
We brought this issue up at the pre-meeting. And I think, Jim, you're actually on the board or committee, whatever, that's looking into where the location will be, and a meeting with other colleagues.
I don't think I could quite say that, but I am trying to walk the line with feet in both camps and trying to make sure that we get the right outcome for Dorset Council to deliver savings and reorganise its property portfolio, but also make sure that we get the pensions team the right accommodation for the work to be done, and that it doesn't disturb the implementation or the go live.
Yeah.
Chairman, if I can just add, it's also my portfolio as a Dorset councillor, so we are well represented to protect the interests of Dorset pensions.
Yeah, good. Thank you very much, Councillor Wharf. Any other questions? Thank you. No, in which case, I believe a recommendation on paper basically to note the report Did you say you wanted to change the wording a bit or something?
Chair, it was also to approve the two policies subject to the dates being confirmed as working days, which I'll take away, and Karen and I will deal with that.
Okay. Can I see all those in favour of noting the report?
Agreed.
Anybody against? Thank you very much for that.
Agreed.
Good, thank you very much. Then on to the independent advisors report. Over to you, Alan.
Thank you, Chair. Well, we've had a good discussion already, and I won't go through it all again. David certainly is on top of the macro arguments. The only thing I think we might just tease out a bit more is this inflation concern, because it clearly has unsettled markets this year. And just to give you one quote, the 20-year gilt market, which is the one most relevant to our liabilities, yields have gone from 0.7% to 1.4%. It's a hell of a move. Now, there's been a slight correction in the last 2 or 3 weeks, indicating a slight lessening of inflation concerns. I think that's now back to about 1.25%. And underlying that is a rise in implied inflation at the 20-year level from 3.3 to 3.6. So that's what our inflation hedging strategy is designed to mitigate, obviously. But that has been a concern. And the concern in markets is how would the central banks and governments respond? And I think the view was Jerome Powell of the Fed said, well, they're going to look through it for the time being. But their target is a 2% inflation rate. And when it gets up to 5%, that self-confidence might be getting slightly tested. In the UK, I think it won't mean higher interest rates. The Bank of England isn't about to start raising base rate, but it might mean it stops its quantitative easing, buying bonds from the market, and it might in turn start selling them around. So it sets pressure on long gilt yields for some time, which has some consequences. I have begun to change my own view on inflation. I think Councillor Wharf was expressing a pretty bearish view. Not going that far, but I no longer think we can be complacent about it. And the labour market is tighter. We've heard already how difficult it is for employers to get staff, and we've had a large movement of East Europeans back to the continent. We've got supply shortages coming out of China. We've had Brexit supply shortages. So I wouldn't be at all surprised to see inflation moving through the 2.5% forecast for the end of the year into the 3 to 4% territory next year. And then we are very much dependent on the wage response, the labour market response. And in the public sector, teachers have got a 2.5% pay rise bedded in, and so on and so forth. So we need to be a little more cautious there, I think. I won't dwell any more on the macro, because I think, as I said, that's been well discussed. Let me just draw out 1 or 2 comments about strategy and asset allocation, which will lead into Dave Wilkes' report in a moment. We're pretty well near the target we set ourselves following the valuation of 2 years ago. We've got equities to over 50%, 50% is the target, and that's very much led by global equities, 40%. So we're in a good place there. We are still a little overweight our corporate bonds, and we're losing money in corporate bonds at the moment because they really price off gilts, and I can't see any happy news flow in the short term. So we could trim our corporate bond holdings. We can top up elsewhere. For example, the diversifying returns fund, we're still slightly underweight. Infrastructure, which we've discussed, we're underweight, but then we have to wait upon invitations to invest in the funds. So anyway, that job's been pretty well done, so we can move on. The LDI portfolio, which we don't normally comment on, pleased to see in the report from Insight, we made whopping gains from our inflation hedges in the first quarter of this year. We lost some money from our nominal gilt holdings. We've now recouped all the losses we made when we first had the discussion, remember 15 months ago, about the RPI TPI wedge, which went the wrong way, and the government is not going to compensate orders index link for moving to the CPIH movement. That's going to be challenged. I'm sure there will be challenges in the court, but for the time being, we've lost that debate, but luckily without any consequences in terms of pricing of inflation in the market. Now, as I said earlier, the leverage of this portfolio has dropped significantly from 3 to almost 2, because we've made these gains on inflation. So we could increase the inflation hedge ratio, or we could even take some collateral away from the portfolio if we wanted to use it for other purposes where we're underweight. that's a discussion to be had down the line, but I leave you with that thought. And finally, if I may, I'd like to talk about the big picture, which new councillors in particular maybe will want to focus a bit on. That is the funding ratio, which is the ratio of our assets to liabilities as calculated by the actuary every 3 years. And it's somewhat disappointing to see that our funding ratio has fallen from the 92% we had March 2019 to 85%, which it was at the end of December and has remained so at the end of March. I had hoped to see some improvement in that, but as you know, a deficit needs to be repaired over time by either higher investment returns, I quoted that 5%, which is the minimum expectation we need to get, or by increased contributions, which of course is the political issue. Now, why hasn't the funding ratio improved? I think one reason, and Dave and Aidan may want to respond in their report, is that our actually takes a smoothing basis. So they smooth asset returns every 6 months. So we won't reap the benefit of the last rally in equities. The second is because equity markets have had such a strong return, they probably are now factoring in lower future returns, which means a lower discount rate, which means higher liabilities. A bit complex, but that's the way our actuary does his calculation for the discount rates, like circularity, the argument I've always thought. And the final argument maybe is this rise in inflation, which is implied by the yield curve, and that will push out the liability calculation still further. I would hope to see the funding ratio improve in the current quarter. Let's wait and see. I noted in Karen's report, which we didn't discuss, there was the report of a visit or discussion with the Government Actuaries Department, which is covering all local authority schemes, and it surfaced the potential tension between our funding level, the 85%, and the contribution rate. And that's a debate we have every 3 years, which you'll have presumably next year. But for political reasons, I suppose, the contributions are always kept down. And that has meant that the funding ratio isn't closer to 100%, which it is with some schemes. We're certainly not in the worst possible place, but we are very dependent upon our asset allocation and our portfolio management returns to close that gap from 85% to 100%. So I just leave you with those observations on where we are. Not quite the response funding terms I'd hoped for, but hopefully better news to come. And I'll leave it at that, Chairman.
Thank you, Alan. Are there any questions for Alan? Okay, I think he's very correct to focus on the effect of inflation. It's one of the big issues that we face. And I think that one of the key things we propose to do at our next meeting is to meet with our with Insight and go through what the alternatives really are, starting from today's position. Because I think inflation could be the big debate for the next 2 to 3 years. As David was saying, the markets do tend to look forward on these things, but I don't think there's any guarantee that even if we do get a blip in inflation in over 2 or 3 years, suddenly things will turn around for the better immediately afterwards. I think there's a big reluctance on the part of central banks to get tough or even to get things back to where what we might call normal situation. I mean, just to end the quantitative easing and to put interest rates back to where you'd expect them to be with the current inflation rates. It's a big ask, and when the Fed did try to tighten previously, one can argue that it did create the background for the big sell-off that occurred on COVID, and maybe that was going to happen anyway because the market was reacting to the Fed getting tougher. And all they were talking about doing was restoring the normal balance between interest rates and inflation. And it's quite incredible that we seem to live in a world where we're almost addicted to easy money, and trying to wean us off of it is going to be very difficult indeed, or very difficult indeed. So I think that one of the key things in our September meeting will be the talk about inflation expectations and where we go forward on this.
We certainly have scope, given the leverage ratio is so low, to increase the hedging ratio. To remind the committee, we did reduce the inflation hedge ratio from 40% to 30% last year when we were so troubled by this debate about changing the basis for inflation calculations. So we have scope to move back part of the way, if you like, without I think increasing too much volatility into the portfolio.
Yeah. Councillor Christopher.
Yes, as somebody who probably speaks to more business people than just about any other councillor within Dorset Council, one has to bear in mind that inflation is very much different across various commodities. And we certainly see this with the price of oil, whereas it was $40 a barrel for Brent crude, and now we're about 73, etc. That is a phenomenal gain. If you look at the phenomenal increase in the price of oil, it's almost taking us back to where we were 3 years ago. And it has outstripped, for instance, the performance of the FTSE, which was at its lowest ebb at 5,600, and now we're just above 7,000. So it is a fundamental impact, and it does capture the imagination of those who live in rural areas, obviously. But it also impacts clearly on house builders, and house builders are the great driver of the economy. And we see the increase in the price of timber, and all these factors within inflation really should govern all our considerations, because this is what is impacting on share prices. This is what's impacting on businesses. And it's all very exciting as we go about our councillor lives. We look, for instance, all the houses being built, but those house building is being held back because of the increase in the price of raw materials. And we shouldn't lose face.
I think it's a clear problem. I mean, and there are clearly shortages of labour. I mean, there's a report on the news the other night about the hospitality sector, which has obviously been hit enormously by COVID. And the problem is that they can't recruit anybody. The staff have gone off to better paid work elsewhere in the economy. They can't bring in workers from Europe, where they used to be able to do so, and they're actually really struggling at existing pay rates to actually, so that when they do fully open up to the economy, to the post-COVID situation, a lot of them are going to struggle to find staff to operate the hours properly. So there does seem to be a pent-up, behind the scenes degree of pent-up inflation problems there. Councillor Beasley.
Thank you very much, Chairman. I just wanted to pick up on Alan's point about the Dorset Fund's funding position, which, as you'll have seen from the report that David will be presenting in a moment, has deteriorated from the previous 92% to an estimated 85%. This is an issue which the Scheme Advisory Board has been reflecting on across the country, and what the last Scheme Advisory Board meeting heard in May of this year was that GAD, that's the Government Actuaries Department, are looking at spread periods and mitigation of risk and so on. And I hope to be able to report back to this meeting next quarter as to whether that situation has changed or how long they're likely to be deliberating. That will be hugely influential on what our actuary will see to be permissible for us. And I think it's something which we need to know as reasonably urgently as possible. So I'll come back as soon as I have any more information from a government perspective.
Yeah, that would be very helpful. Thank you. Any other particular question for Alan? No, in which case we'll go on to David's report.
Sorry, Chairman, I think Councillor Brown had a question.
Oh, sorry, I didn't see that. Sorry, Councillor Brown.
Sorry, it just came in the last minute there. It's just to pick up the discussion a moment ago. Then I don't know Alan's view about labour markets and about labour shortages and difficulties with recruitment. And it just occurs to me that that may be, to me, it may be a summer thing that actually resolves later in the year because of the impact of furlough. And I think there's still quite a few organisations with a number of employees who are furloughed, who are waiting to see how things pans out to make decisions over the coming few months about what they do with their staff who are on furlough, whether they come back part-time or whether they're made redundant. And I think there's possibly a section of the labour market who are at home being paid on furlough, but actually come August, September may then be looking for new roles. So I don't know if there's anything about, for me, it's a bit of a sort of one-off impact on the labour market, the sort of impact of furlough, and we'll have to wait till September really to see how that pans out.
Yes, that's true. But of course, the inflation problem is, broader than the UK, and it is hitting hard in the US already, where people were laid off in spades, weren't they? And now we're getting an incipient wage price spiral in the States. It's all come quite surprising. But there is some slack in the labour market, but not nearly as much as we thought. And Andy Haldane, the chief economist of the Bank of England, has been going on about this for a long time, that there's not enough slack, so wages will start to respond.
Yeah. Okay.
Well, the Church of England, though, has frozen clergy salaries for the second year running, so they are at least making a gesture.
Okay, good. Yes, we'll move on to David's report.
Thank you, Chairman. As ever, I don't intend to go through this in detail. I'll try and highlight and expand on some key points, but of course, happy to take questions. So, following kind of hard on Alan's footsteps, really, I think the funding ratio is perhaps the key point, just to talk about a bit more within here. So, as the report says, the value of the fund's assets at the end of the year were 3.3 billion, which I think in the pre-meeting the chairman noted was the all-time high that the pension fund's ever been at, compared to 2.7 billion at the start of the year. And that reflects a 10% increase from where we were as at the end of March 2019. So the date when the last full valuation by Barnett Waddingham, the fund's actuary, was undertaken. And at the time of that valuation, the actuary used a discount rate of 5% to calculate a current value of our estimated liabilities of the fund. And Barnett Waddingham's methodology for discount rate is that they discount by the expected long-term average returns of the fund's mix of assets. So Barnett Waddingham at that point we're estimating an average annual return of 5% per annum on our assets. So the value of the assets is now back, if you like, in line with where they were expected to be. So it's I have got a graph which isn't in the pack, but shows the kind of the journey that 10% has taken. It hasn't been the nice smooth straight line upward increase that we might have hoped for. It's been, we've seen quite a few swings and roundabouts in getting there. So the assets now are back kind of in line with where we were expecting them to be. But as Alan mentioned, and as in the report, that those assets now only estimated by our actuary to only cover 85% of the present value of our liabilities, whereas at the full valuation back in March 2019, or based on March 2019, that was 92%. So Alan mentioned some of the potential reasons for that, which I'll come back to. But before I do that, I think it is worth stressing that these quarterly updates are a very high level estimate. So once every 3 years, the actuary does a full valuation, and they go into a huge amount of detail in terms of what our expected liabilities of the funds are. So looking almost at individual pensioner or individual member level. So and estimating what based on demographics, what likely life we will have, all us members, and what potential salary increases may be for those of us still working, etc., etc. So these quarterly updates that they give us are basically using much of the same assumptions that they base their 3-year valuation on, and then they're rolling forward. So need to take a pinch of salt with these quarterly valuations, but they are something that we've been doing perhaps for the last 2 or 3 years now. We never used to do this, and it is to kind of sound the early warnings as to, you know, where our valuation is heading, so that when we get to the 3-year point, it's not a complete surprise as to where we may be. So Alan talked about a number of different potential reasons for the fall in the funding percentage. So the actuary has made some small increases to their assumptions for inflation, so for CPI in terms of pension increases and salary increases, but at the moment those assumptions are changes in assumption are quite small. Now, given the discussions that we've had both with David Vickers and with Alan's report, whether those inflationary pressures will start to feed through into latter quarterly updates that we get from Barnett and Waddingham remains to be seen. But the big difference for the fall in the funding level is that again, one of the reasons that Alan put forward is that the actuary are now revising down their expectations for asset returns, and in particular in terms of equities. So they are now, in order to come up with this funding ratio, they've actually used a discount rate which is 0.5% lower than the 5%, so 4.5%. Now, the reason for this is because they are been looking at the levels of dividends that have been paid since the start of the pandemic. So this is kind of driving their forecasting of what they think likely returns are going to be. However, they do acknowledge that the decline in dividends appears to have bottomed out, and that there are signs now that dividends are starting to increase. So again, their comments which relate to the fact that if the global economy does continue to bounce back in the next couple of years, all other things remaining equal, which they often aren't, we would anticipate seeing that discount rate would go up again, and that then has a knock-on impact on the funding level, so improves the funding level. I might just pause there because before I mention that, I think that was the main thing I wanted to mention. I was going to highlight a few other things, but I wonder if I'll just pause there and see if there are any questions about that.
Well, that is a very significant move. It certainly explains it. I think we felt at the time 2 years ago the return assumptions on equities were rather high, which produced a 5% figure. The typical discount rate across local authority funds, I think, is closer to 4 to 4.5%. So we're moving more into line with those others. But that would explain the whole move. It's a strange methodology he has, but it's what Waddingham have always employed.
Okay, thanks, Alan. So I think the other points really, I was just going to highlight a couple of the key numbers, which were that, which we've seen this nearly 24% return over the financial year to date, and that's above the combined benchmark for the year by about 3%. I think David Vickers and as mentioned about the fact that in the final quarter of our financial year that performance was down against the benchmark, and I think David's given some good reasons for that in terms of how we're positioned in terms of longer term, in terms of we are reducing our UK holdings, we are reducing our exposure to fossil fuels, etc., which have done outperform the market, if you like, in that particular quarter. But I think I would probably echo David Vickers's comments, but perhaps Alan's views on it might hold more weight. But I think longer term, I think we still are positioning ourselves better for the longer term trends. And as David Vickers said, that there will be some bumps in the road where that isn't working out quarter to quarter, but we just need to keep an eye on the longer term picture and ensure that quarter to quarter doesn't become a sort of sustained trend would be the concern. Also, I think, as been mentioned already by Alan, 30% of the fund's liabilities are hedged against inflation sensitivity through our mandate with LDI, Insight, sorry. And we're able to do that, or Insight are able to do that on our behalf, but by only using roughly 11.5% of our assets to do so. So as Alan mentioned, up until about a year ago, we were targeting 40%, and then we took the decision to reduce our exposure to this mandate because of the concerns about the change in terms of RPI or change from RPI to CPI. We've also mentioned that nearly 60% of our assets are now under the management of Brunel as well. Now, the only, and I just wanted to, again, I think Alan may have stolen my thunder slightly on this, but if we move to, I think it's page 146 of the report, you'll see that there is a table there in terms of where we are in overall terms against our asset allocation. So in terms of our listed equities, we've made a number of changes before Christmas and after Christmas, and I think I reported back in March that we'd completed that exercise. So we are now sort of broadly in line in terms of where we want to be in terms of listed equities. We've made a big step up so that we're in up to 50% of our asset allocation now in terms of equities. And then the areas where we are still off a bit are primarily on the private markets. So private equity, for example, being a big one, and infrastructure as well. You'll recall that we did actually increase our allocation to infrastructure back in September, but the private markets are much harder to implement those changes to get the money into the ground. And I think with the chairman's agreement, one of the things I'd like to do in September is to look at the private markets in a bit more detail, and I think to potentially look at private debt as an asset class that we might consider investing in. You'll recall that part of the work that Mercer did for us did suggest that as something that we might want to look at in a slightly longer term. There's an opportunity. The next opportunity with Brunel to make commitments to their private market funds will be March 2022. So I think it would be opportune for us to start thinking about how we can actually what we need to do to try and hit these targets in terms of private markets. And I think Alan also talked about corporate bonds, which is under the management of Royal London Asset Management. We are overweight still in there. We have reduced down, as you can see, from about 8% to about 6%, but we're still 2% over on that. So we perhaps need to think about what we want to do with that money. Do we want to wait until there are private market opportunities, or do we want to temporarily move that into other asset classes? Or as Alan said, do we want to take the opportunity to kind of increase the assets that we have, given the fears that have been raised by a number of people this morning and elsewhere about inflation? Do we need to take the opportunity to look at increasing our allocation and our target in terms of liability matching assets? I think that's all I wanted to say, Chairman. Sorry, apologies.
I think certainly there's a debate to be had about the inflation liability, but I think we need to do it properly and have a proper debate and proper time to look into this, which is why I suggest we do that in September and have that as part of the training day before the formal meeting, where we can actually go into this into some detail, particularly as we do have a couple of newer members who won't have looked at inflation hedging previously. So I wouldn't want to move anything today based on that. But having said that, I think that there is room to add a bit more into the diversifying returns portfolio, where we're a bit underweight. I mean, we could just take that from cash, couldn't we? Because we're all corporate bonds, basically, I suppose, would be the logical choices. Alan?
I think a switch out of corporate bonds and into the diversifying return class is a easy win. That is the strategy. So just a question of the timing of the implementation. And I think really committee has given us discretion to go ahead and implement that. But to have your endorsement would be good in terms of the timing.
Yeah.
On the private debt, which Dave mentioned, committee should be aware this is a very illiquid asset class, just like holding private equity infrastructure. You're in there for 7 or 8 years or whatever. You've got to be prepared to put that money away and forget about it. We didn't discuss property, Dave. Will you be reporting on CBRE?
I wasn't intending to make any comments on CBRE,
Okay,
but
so
happy to answer any questions. Or
because I noticed there they were slightly overweight against the allocation we set them. Now they appear to be underweight, which is a reflection, I suppose, of the fact that nothing's happened in property and a lot has happened in equities. So property's already got down to below 10%. And we're getting returns of 1 to 2% from property now. In other words, capital values are still falling, offset in part by a high running yield of 4 to 5%.
apologies, Chairman. There was one thing I just wanted to mention on the asset allocation, which came back to some questions that Councillor Christopher, I think, or some comments that Councillor Christopher raised earlier in terms of infrastructure. So I guess for Councillor Christopher's benefit, you'll see from that that table that we have got a diversified holdings against different asset classes, and that in infrastructure we do have an 8% target allocation. We're currently at 6.6% against that.
Yes, Councillor Christopher's benefit. It is a perpetual difficulty with infrastructure and with private equity. Is the deals only come along rarely and occasionally, and we've got to have some money set aside to take advantage of them when the appropriate things come along. But what often happens is that a year or 2 or 3 years might go by, and we just don't find anything that's worthwhile investing in. But the money is available should we find something that appeals on that front. Certainly, the comments that David Vickers was making about lobbying government, I think, are well founded. Councillor Brown, I think, was the first person who had their hand up.
Yes, thank you, Chair. Yeah, just on that asset valuation summary, just one quick, I think it's a typo in paragraph 10.1, the dates that are there. It talks about the 31st of December 2020. I think it should be the 31st of March 2021 in that paragraph.
Yes, you're correct. Apologies.
Yeah, obviously it sort of needs to update from the last one. Just sort of further to the conversation, obviously we're slightly overweight in corporate bonds, and I agree that that's something could look at to move to diversified returns or infrastructure or private equity, etc. But just picking up on what Alan said, obviously things like infrastructure, private equity, property take time to make those moves, but also then takes time to come back out of it. Am I right in thinking those 3 areas are the most illiquid of our assets? And I think according to the target allocation, we're looking at about 23% over there. So I think it's probably not a bad thing that we're slightly underweight there. But I agree with you, David, that we need to, if we're going to sort of aim for our target allocation in those areas, we need to be doing things because it will take some time, maybe a year or more to sort out those sorts of deals and those sorts of opportunities. So but yeah, I think it's right to be a bit cautious, because obviously they take time to get in, but they take time to come out as well.
Well, I think when we've got a core in relatively liquid investments, it's not necessarily we'll ever come out of it. We probably actually don't ever need to touch that money. It's just a fifth or a quarter at most of our total assets. And unless something was going on for some other dramatic reason why we wouldn't want to be in them, they really are literally just lock them up in a cupboard, forget about them, and they just produce regular supply of income and capital gains hopefully over time. But we wouldn't probably ever be looking to sell them potentially.
Well, private equity was one of the first recommendations I made when I joined the committee in 2005, I think, and we've never got to our target actually, because they keep giving money back to us. I think if you look at the breakdown, we've received almost as much money as we've invested. So we're pushing water uphill to get to our target allocation. That wasn't the case with infrastructure. We got pretty close very quickly there, didn't we, Dave?
That's right, we did.
Private
Yeah.
equity has been a struggle. I don't think we'll ever get to our target allocation. You really have to overcommit, which of course is a bit of a risk if all of a sudden they come to you saying, give us your money. And we've been a bit cautious in that respect.
Yeah, yes, that's right, Alan. And I think that's one of the things I'd want to try and, well, I was suggesting that maybe we talk about private markets in September as well, in that we need to try calculate the commitments we need to make to the Brunel funds to give us a good chance of getting up towards our allocation. But private equity is, unfortunately, as Alan says, you can't just put your money in and forget about. With property, yes, you can buy properties, and if they're good properties and they give a good rental return or capital return, then you can kind of, hold them indefinitely. With private equity, it takes a long time to get the money invested, and then, as Alan says, quite often that money starts then coming back to you in distributions. So you have to continually review and commit to the funds that come up. Our investment in our infrastructure funds are slightly differently structured, and which I think is probably due to the nature of the underlying assets, in that you will invest your money in that, and if they do sell any of their underlying investment assets, they will be looking to purchase replacement assets. So you don't get that same kind of put your money in and get your money back that you as you're going along, as you would with private equity.
Councillor Christopher?
Could David just comment on the current PE ratios within the existing portfolios? Clearly, you can only receive dividend incomes out of earnings. Would you say that PE ratios are particularly high within that portfolio that we have with Brunel?
I don't have that information, I'm afraid.
Come back to me with your thoughts on that, if you will, please. Thank you.
Okay. Any further questions for David?
Chairman, I think it would be an excellent idea to review the private equity and infrastructure and property managers in September, if you have the time, because they hardly ever appear before this committee, tend to give them the money and forget about them, with the exception of property, and we haven't seen property for a couple of years. So I think that would be a very good opportunity. One of the same pity for the committee is that previously we used to get lots of presentations from fund managers, but now, of course, because of the Brunel involvement, that doesn't happen very often. But all of our illiquid asset managers are outside the Brunel pool. We will continue to have a direct relationship with them. Yeah. So September will be a very good opportunity to catch up with them all.
I think as well, although it's not an automatic thing, I think we should look in future meetings in future years, meeting with the managers that Brunel have employed as well. It's certainly the ones that are based in London anyway. I don't see that there should be a problem with arranging for us to meet them directly and to get their thoughts directly on the markets and opportunities in their specialist fields. But at the moment, you're right. We get most of our information from Brunel, and then the rest of it we should be speaking to our other more illiquid managers to find out what their views are on things as well. Okay. Councillor Christopher, is your hand up to ask another question, or is that just a leftover one?
Well, I left that hand there just so to come back. In relation to corporate bonds, because of course corporate bonds have a different perspective as opposed to equities in terms of actually delivering an income stream. We shouldn't forget that we never live too far away from a bad recession, and the fact that we need to consider income streams in the future and the security that's provided by corporate bonds relative to equities. That was the reason for leaving the hand out.
Portfolio highways, travel, and
Alan, did you want to comment on that at all?
Yes, that's true. In fact, Mercer's, the external consultants we brought in 2 years ago, wanted us to sell down the complete corporate bond portfolio because they saw us making losses as yields rose, and invest in private debt. We resisted that recommendation. We're now saying we'll have another look at the private debt situation. But we really look at our portfolios on a total return basis. So what sort of return can we get from corporate bonds in total? 4% maybe, but equity 6 to 7%, which is why we're overweight in equities compared to bonds. And luckily, we have no gilt holdings. Otherwise, we'd be now seeing red on the board.
Indeed. Any further questions for David? Okay, in which case we'll move on to the dates for future meetings. And we are still hopefully intending to meet in London in September.
That's the intention. I think we were going to wait till we got to this meeting, and then I think we'll start trying to put that in place. But I think I will try to line up a venue in Dorchester as a backstop. Without wishing to be too pessimistic, hopefully, given the announcements yesterday, that we may see a sort of return somewhere near normality at the beginning of the mid-July or towards the end of July, which and hopefully by the time we get to our meeting in September, that we should be able to sort of go about our business as we would have done otherwise.
Well, I've seen a raft of hands going up here. So, Adrian, you first.
Thank you, Chairman. I see as part of, I believe it was Karen's report, we had some reports on Prudential and their provision of the additional voluntary contributions and the issues that Prudential have been having in being professional in the way that that's gone for. It was I think it was a year or so ago that we called for a review of the provision for AVCs for Dorset pensions. Have we got any further with that?
I think that's a question that only Karen can probably answer.
Right.
So if we could note
Chair.
that.
Chair, could I add a little bit of context there? The bit that's probably not obvious from Karen's report is that we did find a workaround for the Prudential not being able to provide us with the information this time round in order to get the end of year returns done. So we've done that, and there'll be a checking exercise once the Prudential information comes in to harmonise it all. But it is one that I'll need to talk to Karen about in terms of whether a review has been done or is planned. But I'll take that one.
If you get to email the committee with the answer to that, that'll be very helpful, I think.
I will do. Thank you.
Councillor Roberts.
Thank you, Chair.
Yes, thank you, Chair. I was just querying the proposed trip to London. Will it be the similar format to other trips?
Yes, it would, with the intention being to have proper training and the opportunity to dig underneath the surface of things on the first day, and then the meeting the following morning.
Thank you.
Councillor Beasley.
Thank you, Chairman. Just looking at the agenda, it states Wednesday the 7th of September. I had it in my diary that it was Wednesday the 8th of September for the pension committee meeting, and I therefore assumed that we were meeting with others on Tuesday the 7th of September. Could we just have clarification as to the dates, please?
David, that is a typo.
Yeah, I'm afraid. Yeah, well spotted, Councillor Beasley. Apologies for that. It's travelling up on Tuesday the 7th, and the training day will be on the 7th, and the committee meeting itself will be on Wednesday the 8th.
Thank you, Chairman.
Okay, thank you. Anything else on future meetings?
Chairman, on Tuesday,
Yes.
sorry, the Tuesday, there is a Dorset Council Cabinet in the morning. So I don't think it makes that much difference, but any Cabinet members and others who wish to attend the Cabinet meeting will therefore not be available until 2 o'clock or so.
Sure. That's unfortunate, but I guess it's just finding times when most people can do it is always a challenge.
Yeah, absolutely.
Okay. Anything else? No. In which case, we'd like to move on to exempt business. So would one of the councillors recommend that we move into private session, please?
Chairman, I'm happy to do that, to move the appropriate recommendation for us to move to private business.
Howard, are you seconding that? Thank you. If we can go down now to just having the councillors and the relevant